Welcome to the Week 4 PowerPoint, where we're going to review some more important qualified plan basics. Here are the basic qualified plan rules. Discrimination is not prohibited to a large extent in comparing highly compensated employees to non-highly compensated employees or comparing key employees to non-key employees. Discrimination is basically prohibited. Now, if you did want to target certain executives to receive better benefits than others, you can do that, but it must be through a non-qualified deferred compensation plan, which we'll study later on. In qualified plans, ERISA rules apply. So that's the basic age 21 and 1 year of service rule. ERISA also has a lot of rules concerning coverage testing, participation rules, vesting rules. And remember that in a qualified plan, we can only consider the first $260,000 of compensation when plugging that into the qualified plan formula. So for example, a person making $25,000 in a profit sharing plan with a 10% contribution gets $2,500 put into their account. But a person making $500,000, we don't take the 10% of the $500,000, we take 10% of the $260,000 because that's the compensation limit in a qualified plan formula. The employer contributions are deductible in the year the contributions are made as long as the qualified plan continues to pass the non-discrimination testing. The earnings grow income tax deferred for the employee. And qualified plans can be rolled over to an IRA or qualified plan when the plan is vested, and normally then when you leave employment. And here's a review of defined contribution plans. The plan document specifies how the employer contributions will be made. Therefore, it's called a defined contribution plan. The employer is limited to employer contributions each year of 25% of covered payroll. That's the payroll of the employees who are in the plan. Cannot exceed that amount for employer contributions. There is also another limit, which is the grand total of employer contributions plus employee elected deferrals, if any are permitted, plus any forfeiture reallocations. That would be people who were not fully vested and the money is redistributed among the accounts of those who remain. So the grand total of those three items in any employee's individual account cannot exceed the lesser of 100% of their salary or $52,000 in the year 2014. In defined contribution plans, each employee who is in the plan has an individual account and they are responsible for the investment risk. Although the employers may make certain mutual funds or other investments available and they might choose which ones they're offering, it's the employee who's responsible for picking the funds they want, the investments they want, and they're responsible for the investment performance. Defined contribution plans tend to favor younger employees because they will benefit by many more years of contributions than a brand new older employee who is approaching retirement. And defined contribution plans tend to have a lot lower administrative costs because you don't have to have the actuary coming back every year, which is a big expense in defined benefit plans. In defined benefit plans, the plan document spells out how the employer is going to provide the benefit to the employees who are in the plan. So these plans define the benefit. So employees know how they're going to get their retirement income from the company when they retire. It could be based on a fixed dollar amount for everybody. It could be based on a fixed percentage of compensation for everyone. It could combine years of service and compensation also in the plan formula. The maximum defined benefit amount permitted this year is $210,000 or 100% of compensation, whichever is less. So no one who is receiving a defined benefit payout this year can get more than $210,000 in retirement payments from the company in 2014. Defined benefit plans are not subject to annual additions limit because there are no individual accounts. All of the money for the various employees who eventually will receive benefits is in one commingled fund that the employer is responsible for. And the employer is responsible for the investment performance. So if the investment portfolio is behind schedule from where it needs to be to grow to provide all the required benefits, the employer must make up the difference, and the actuary will tell the employer what needs to be put in. Defined benefit plans, especially the defined benefit pension plans, tend to favor older employees because they have a compressed amount of time until they retire for the employer to fund an amount that will provide them their defined benefit amount. Since they have a shorter amount of time than younger employees, they're going to have a disproportionately larger amount of money being put in for them by the employer. And so they tend to favor older employees. Defined benefit plans tend to have higher administrative costs than defined contribution plans because you have to have an actuary at the time the plan is set up, plus the actuary must come back every year to tell the employer, after doing a lot of complicated calculations, how much the employer needs to put in each year, and that is a major expense of the plan. Also in defined benefit plans, each plan must pay into the Pension Benefit Guaranty Corporation, much like SPIC or FDIC, like banks have to do, SPIC with brokerage firms. Defined benefit plans must pay into a quasi-government insurance company so that in the event of a real problem with the account assets, the PBGC can step in, take over a plan, and then at least provide some minimum benefits to those in the defined benefit plan. This slide shows you one of two ways in which we can categorize qualified plans, and this is defined contribution versus defined benefit. The defined contribution plans, again, have employer contributions defined by the plan document. Therefore, they're defined contribution plans. They include the most popular type of qualified plan, the profit sharing plan. And if the profit sharing plan allows for employees to defer part of their salary, we call it a profit sharing 401k plan. Now, the advantage of the profit sharing plans and the profit sharing 401k plans for the employer is the flexibility of the contributions. The employer can choose anywhere from a 0% contribution up to 25% of the covered payroll as the contribution for the year. And the contributions do not have to be based on actual profits. Another type is the simple 401k. It is similar to a simple IRA, but it does allow for loans and does have to follow the compensation limit of $260,000 in the formula. A stock bonus plan is a type of profit sharing plan in which the employer generally contributes company stock into the plan instead of cash. So this is a way for the employer to fund a qualified plan without having to upset the cash flow of the company, and this structure will work as long as the employer is willing to share ownership. And another advantage of the stock bonus plan is now that the employees have a lot of shares, the employer has somebody to sell to when they want to retire. An ESOP is a type of stock bonus plan which is a subset of the profit sharing plan. An employee stock ownership plan, which works the same way, only there is a trust involved, and the trust has the ability, if the plan document allows for it, for the trust to borrow money from a bank or brokerage firm to leverage the purchase of the stock that goes into the plan. A money purchase plan has a set fixed percentage that the employer must contribute for each person who is in the plan. That percentage can be anything up to 25% of covered payroll. A target benefit plan is similar to an age-weighted profit sharing plan in which the older employees get a little bit extra contribution versus the younger employees. You do need an actuary initially to set up the plan. The actuary spells out to the employer how much is going to be needed to provide the desired benefits to the employees. But then the plan runs as it runs according to the economy and the performance of the investment. So the end result could be the amounts in the account on day one of retirement are above or below or the same as the targeted benefit. In the defined benefit plans, the employer is responsible for the investment performance. There are no individual accounts. It's one large commingled account. And the employer is responsible for putting into the plan each year the amount that the actuary says is needed to keep on schedule to provide all the promised benefits. Defined benefit plans were very common with the old economy type companies. We don't see as many of them these days, although they can fit very well for a service business like a doctor or dentist or accountant, where that owner of the business is much older than the rank and file people who work for that person. And this way there can be a disproportionate amount of money going towards the owner. It also helps if there's not a lot of time for the owner to develop a retirement savings before they retire. It will get a lot more money into the plan and therefore a bigger income tax deduction for the employer versus a defined contribution plan. The cash balance pension plan works much like the money purchase plan, but there is an actuary that's needed and contributions must be made. There's either a fixed interest rate, much like a CD rate, that is attached to the funds, or it can be based on a variable rate. A 412I plan is a plan in which an insurance company takes care of the investments and compliance factors, and these days has a lot lower interest rate, but the trade-off is the employer will get to deduct a lot more contributions that will be needed for such a plan. In this slide, we take basically the same types of plans we had in the previous slide and reposition them under two different categories. This time we're going to have profit sharing plans versus pension plans. The difference is that the profit sharing plans have flexibility in the contributions, and they are not pension plans, and so therefore they are not subject to a minimum funding standard. The pension plans, which are on the right side, and notice there are some defined contribution plans in there, such as the money purchase and target benefit plans. The pension plans must provide definitely determinable benefits. They must put in monies according to the required schedule based on the formula of the plan, and they must meet the minimum funding standard for the defined benefit plans. They must put in a minimum amount to stay on track. They must do that each year, and that's the requirement for pension plans.